Hey friends, Adrian here and welcome back to the channel. Most multifamily investors came from investing in single-family houses, including yours truly. And in that space, cash-on-cash return is hailed as the most important metric. But in large commercial multifamily, it is only one of many data points to consider. So in this video, we're going to talk about what is cash-on-cash return, its misconceptions, and lastly, how it is used in multifamily real estate. Let's jump right into it. Cash-on-cash return is simply a measure of your return as a percentage based on how much you invested. The formula is cash-on-cash return equals annual cash flow divided by the equity invested times 100 to get the percentage. For example, if you invested $100,000 in the deal and received $5,000 at the end of year one, that's 5,000 divided by 100,000 times 100. You got a 5% cash-on-cash return that year. Okay, let's move on to the misconceptions. The first one is seeing a zero or negative cash-on-cash return as a bad thing. More often than not, multifamily operators acquire a property that has an upside potential. That means the property is not stabilized. It could be that the units are outdated, the property has higher than normal vacancy, or the rents are just not up to market.
Rent?
Whatever the case may be, it is normal to see lower cash-on-cash returns while the property is in the process of being stabilized. Even lenders understand this. That is why they offer an interest-only payment in the first year or so. Another point of confusion is adding proceeds from sale or refinance as part of your cash-on-cash return. That is wrong. Let's use our previous example. Let's say in year 3, you still receive $5,000 from cash flow and $80,000 because the operators refinanced that year. Your cash-on-cash return in year 3 is not 85%, but it's still 5%. But in year 4, if you receive $5,000 from cash flow, your cash-on-cash return is 25%. That's because $80,000 of your $100,000 was returned to you in year 3. The last misconception is for those who are looking to live off of cash flow. So they look for deals with high cash-on-cash return. In order for you to do that, you need to have a substantial amount of equity invested into the deal. In the example we mentioned, you receive $5,000 in year 1. That amounts about to $417 per month. You really can't live off that, can you? So while you're young or just starting out, you should focus on building your net worth or acquiring more capital. Later in this video, I'll explain what you actually need to focus on if you want to live off of your cash flow. Let's move on to how cash-on-cash return is used in multifamily investing. So if you're passively investing in multifamily, it's most likely through a process called syndication. In its very nature, syndication has an exit point where your initial capital is returned and more. That said, you shouldn't focus on living off of cash flow from syndications because it exits in about 3 to 7 years. Actually, the big payout happens when the deal is sold. So you should treat the cash-on-cash return as a buffer or safety net. That means if a deal has a 5% cash-on-cash return, you can think of it as if we encounter a downturn, we have a 5% cushion. The main goal is to reach the finish line and hopefully get a payout large enough that when averaged out over the hold period, that beats 5% by a mile.
I'll make it rain.
So I mentioned earlier what you need to focus on when you do have enough equity to live off, and that is the type of class shares as a limited partner. I can't start explaining what that means without touching on the topic of preferred return. Preferred return describes who gets any of the distributions first. In the case of syndications, the limited partner gets a portion of the distribution first before the managing partner does.
Adrian, what is the difference between cash-on-cash return and preferred return?
The preferred return is similar to cash-on-cash where the return is based on how much you invested. But the difference is that the preferred return does include the proceeds from sale and refinance as well as the cash flow. And now that we covered that, let me explain why picking the class of shares is important. Let's take a look at this deal as an example. As a limited partner, you have the option to invest with Class A or Class B shares. The Class A shares get a 10% preferred return, while Class B shares get an 8% preferred return. And that is if there's anything left over. Preferred return is not a guarantee.
Well, that sucks. Why would anyone want the Class B shares then?
Okay, have a look at the annualized return. Class B's annual average return is almost double of Class A's. That is because Class B gets a piece of the profits while Class A does not. You can think of Class A as a straight-up loan with a 10% interest. We're touching on a very important topic called the equity waterfall distribution. I made a separate video about that. I'll link the video in the description below. Earlier in the video, I mentioned that cash-on-cash is only one of many data points when evaluating a multifamily deal. That's actually a good thing. When going on a trip, you wouldn't only look at your current fuel levels, right? You also have your map, traffic patterns, and the weather to consider. Investing is all about minimizing your downside. With enough data points, it's almost like you're predicting the future. In order for you to understand these data points, watch this video next, where I cover commonly used terms when underwriting a multifamily deal.